Teenage your question now. Excuse me, sir. Let's look at it, the percentage. I'm not excluding this, sir. So, there's a small rounding of error, doesn't matter. It will still convey what I want to convey. This divided by, we're calculating percentage of terminal value to enterprise value. Thank you, sir. But sir, thank you very much. The percentage of terminal value to enterprise value will be a significant amount. It will not be less than 65%, sir. It can go as high as 80%. इसमें थोड़ा simplistic assumptions किया, जैसा आप लोग ने notice किया है, EBIT and growth rate was same. We took the same WACC, we didn't take into account working capital, but that's okay, right? 13% GSEC, you change it and you'll see it. Not less than 65%, sir. I hope now you realize when you all start negotiating about the first 5 years, I think it doesn't really make sense. We need to be focusing on that side, like he said. Can we talk about last 25 years I've been growing? Now, can we talk about what happens when I hit the stable growth rate? Lengthening it from 5 to 7 years to 10 years is good, very good. But you need to again be keeping on looking at what is your absolute terminal growth rate. What's your R at that stage? What is your free cash flow at that stage? This is nothing but your WACC calculations, which is nothing but, right? WACC is nothing but, now that we have done all this, WACC is just a matter of 2 minutes. Excuse me. What? Question? Right? WACC is a very simple calculation. Colleagues, I should compliment you all for the second time today. It's really gone off here. We have finished, right, very well actually. So I'm open for, in the tea break, if there's somebody, please come and talk to me. Right? Some of you all may not like to talk to me in public. I don't mind repeating this. But please understand this, because now I think I can do something extra. Okay? Please understand, WACC is nothing but debt to equity. WACC is nothing but debt to equity. So if you say your target is 2:1, you know the cost of debt. Let's say 15% pre-tax. Now comes a trick. Equity, let us say 20%, but the point of equity is always post-tax. तो इसमें भी थोड़ा एक adjustment करना है आपको. There's a small bit of adjustment that you have to do. A very, very important adjustment that you have to do. A small bit of adjustment that you have to do. You have to make post-tax into pre-tax. That's very simple. Your formula for that is post-tax is equal to pre-tax into 1 minus T. Very simple. Your post-tax is equal to pre-tax into 1 minus T. So are you saying me that, right, 20% post-tax? So if you calculate pre-tax, and let's take very quickly a 20%, right, let's take a 30% tax rate. So it is 20% is equal to pre-tax into 0.7. So your pre-tax will be 20% divided by 0.7, whatever the value. Significant, very costly. That's why I kept on saying that zero debt company, but thank you for bringing the customer perspective. For investment banking, valuation perspective, it's like killing yourself here. Look at this, sir, 20% divided by 0.7. It will come roughly in the range of, thank you, about 30%. You are talking of nearly double. So once you get this, let's take this is 30%. How do you calculate WACC, right? WACC will be weighted average cost of capital. How do you calculate WACC? It will be 2 into 15% plus 1 into 30%. I hope you have understood why I made that 20 into 30, because I was making it pre-tax, divided by 2 plus 1. That's your WACC.
I'm a little hazy on the pre-tax.
Sure. No problem, sir, please. Right? Pre-tax is equal to, always you should remember, there is something known as post-tax. Right? Post-tax means after accounting for tax. Pre-tax means before accounting for tax.
How is my debt going to get affected after my tax?
So debt you have taken as pre-tax basis. Because debt you always get tax sheet. Remember the profit and loss statement, Vishwanath sir?
EBITDA.
That means interest is coming before tax. That means interest is pre-tax.
Okay. For the shareholders, you get it post-tax.
You shareholders, you get it post-tax. That to convert a post-tax to pre-tax, this is your connecting formula. This is, I have no hesitation repeating, please. This is a standard formula for converting any post-tax and pre-tax connection. Post-tax is equal to pre-tax into 1 minus T. You know what it means, Sanjay sir? It means if you take a 10% loan, if you take a 10% loan, actually it's not costing you 10%. It is costing you 10% into, let's take a 30% slab of tax rate, 10% into 1 minus 0.3, that is 10% into 0.7, it's costing you only 7%. Government of India is bearing that 3% for you because you get a tax benefit. यही तो सेम फंडा है ना इतने सर हाउसिंग लोन लेने के टाइम में हम लोग हाउसिंग लोन many of us take this housing loan because we get that interest tax shield of 1,50,000. वही फंडा है तो though I am paying 1,50,000, I am getting a tax benefit on that. तो actually मुझे 1,50,000 नहीं है. For me the cost is only 1 lakh rupees, 1,05,000 rupees. बाकी 45,000 तो tax का benefit है. Please note, this was the percentage. Prasanna sir, thanks for your question. Enterprise value, WACC calculations. Any questions on WACC calculations? Now we come down to, before we break, market value of debt. Some colleagues were asking that. Now you bring in market value of debt, or I would put it as book / market value of debt. Cash and cash balances, you say no, nothing. So you have FCFF minus debt minus cash. What am I calculating here? Is nothing, thank you, is nothing but equity, which is nothing but FCFE, and then you arrive at the value per share. But what is important is to note that FCFE is nothing but FCFF minus net debt. Net debt is nothing but minus net debt, because you need to know what is happening there. That's a value there. What your
One figure was the last part.
Sure. Which one, sir? This part? Last part. Okay.
No, market value of debt and then the last.
Yes. This three. I'll write it down. I'll explain it to you. Sure. I put it right there. I'll show it to you here, sir. And somebody like you will easily grab it. Here we are. What is enterprise value? Enterprise value, you are paying money for the enterprise, which is made up of what? Debt and equity. I'll put it as equity and debt. Equity and debt. Sir? But let's say this company already has got, Sanjay said here in this case it is 0, but I'm explaining the concept, right? It already has got a cash balance of 40 crores. Though I'm actually paying 400 crores, I'm getting that 40 crores cash. So how much I'm actually paying is not 400, it is 360 crores. Right? Sanjay sir, one last time for you, sir. They have got it. I'm paying 400 crores by acquiring this firm, but वो company के पास 40 crore cash balance है. तो actually मैंने 400 crore नहीं दिया, sir. I paid only 360 crores. That means, sir, this is minus cash. Thank you. That means if you want to find the value of equity, you will say enterprise value, sir, minus debt plus cash, which is nothing but equity value. Which if you want to tweak the formula, Saraf sir, if you want to tweak the formula, you would say EV minus debt minus cash, which is equity. Please note, minus into plus is minus, minus into minus is plus. This is what our dear consultants call it as net debt. That's what I've done, senior. That's what I've done. Once again, if you want me, sure. Enterprise value is equity plus debt, but you get cash with the company. So you have to remove that because you're not paying that amount. You're getting it free of cost. Now if you take debt that side, cash that side, you will get EV minus debt plus cash. So moment you take the minus sign common, you will get debt minus cash. Please be noted, minus into plus is minus, minus into plus is minus, minus into minus is plus. This entire thing, sir, is known as, Sanjay sir, it's known as net debt. So EV minus debt is equity. Simple. Prasanna sir, right? This is exactly what has been done here. This is EV minus debt minus cash. Actually, right, I think I should make it more clear. Just make one subtle change. Pass this on, I better be as clear as possible. Now if you want to find the value per share, divide this by the number of shares. End of the matter. That's what I've done towards the end, right? So if you know the value of equity, divide it by the par value, sir. Simple. You know the number of shares, it's given to you, you know the balance sheet figure, just drop it down. End of the matter. Any questions on the sheet? What I'll request is, thank you. There was a lot of interactions. But again, I want to compliment you all. I'm going to leave this. We're going to take a 15-minute break. First thing I want to do is, I'll just take a 2-3 minute break, come back here. Anybody wants to ask me one-to-one also, I'm available. After 4 also, if you want me to repeat this, great. We can repeat this. If not, I'll show you my sheet, working sheet, where actually by subtle changes, you can see how valuation changes. I'll take the question before the break, please. No, bolo na, sir.
No, it's a little more, in the sense, my question is, I think depreciation and amortization came a little later in the entire financial modeling or whatever statement, right? So I was just trying to see the intention of incorporating a depreciation inside the line, I mean, making a line item by GAAP.
So that you get your actual, Vishwanath sir, you get your actual cash profit. Was that depreciation, though it is a loss of value, you're not paying that to anybody, no? So why you incorporated as...
I understand, because you acquire a equipment or an asset and it is generating, let's say you pay 1 crore today and you might enjoy the benefit for a lifetime or 20 years. But for me, when it comes to the expense part, right, how do I put it? That's why I said I'll take it offline.
Okay, no problem, absolutely, no problem. Please take a 15-minute break. My model is there. I'll just take a 2-3 minute bio break, then we can continue. The shortcut method is very simple, sir. If you have to look at what is the leverage of the industry, so what typically is the leverage structure in the industry. So suppose if your company that you are targeting has a leverage structure of only, let's say, 0.5:1, and the leverage in the industry allowed is, let us say, 3:1. That itself will give you what is the additional debt it can raise.
Okay, that's one way. There's another way we've been trying to find out.
I will tell you.
Enterprise value, and we're trying to find out the EBITDA level today that it has, and the debt which it has now. What is the additional debt that it can do?
What in fact, I don't do this also, though I'll give you an answer there. What I normally do, and which I request all of you to do, is just look at the market value of all the assets. Typically, all these guys, when they say debt equity, it goes with the past values when they had taken the loan. So when you are acquiring, you can always go back and revalue assets. So when you revalue assets, suddenly you will see that the asset values will increase tremendously, and you can take a fresh collateral against that. So you can give that same, what you are typically doing is, right, that's okay, right, what you are typically doing is, you are saying you are retiring the debt, and you are taking new debt against that